unless it's specifically excluded. So this is the definition as we speak. And we're going to see on pages 2-3 in table 2-1 and 2-2 what is specifically included and what is specifically excluded. But basically when people say to me, hey, I just bought some goats and then I sold them and I made $300 a goat, is that includable? I know enough about tax law to know that there's no specific exclusion for the purchase and resale of animals. So the answer, there's no goat laws. That's includable, right? I know things that are specifically excludable. You don't, but you're going to be very married to table 2.1 and 2.2.
Question. The amount that you take from goats as charitable contribution, if you get anything from goats, do you have to deduct that from the contribution?
Sure. When you contribute to charity, say you give $2,000 and buy a weekend at the Coeur d'Alene and go golfing. Do you get to deduct the whole $2,000? No, only the amount that you gave over the fair market value, right? So if it would have cost $900 to go golfing at Coeur d'Alene for the weekend, and I paid $2,000 for it, I only deduct the $1,100, right? Can you hit the lights? Or no, I can hit the lights over here. Never mind. Sorry, I'm still learning these classrooms. There we go. At any rate, these tables are going to be your friends because you don't know what's excluded. Okay? I know that it's a very small table and it's included unless it's specifically on the table, but you don't know the table, so you're going to need to have that in front of you. Okay, what else does this say? Virtual currency, there's a lot of things that are giving the IRS all sorts of headaches now that there's a lot of digital transfer of funds. How do we track that? How do we make sure people are reporting that? Bitcoin is taxable. Non-cash items. So I work for Google, and one of the pieces of my compensation package is stock options. Do I have to pay tax on them? Show up on my W-2? Stock options. Yep, third little bullet down here, non-cash items included at fair market value. Right, so all that compensation is includable. I was actually just talking to my son this morning, it's his birthday, and his fiance just got put on his Tesla benefit program. And the value of all of her benefits, third bullet down, non-cash items. So they're going to impute the value of putting her on his benefit package, and that's going to show up on his W-2. Got to pay taxes on it. I said to him, the value of Stephanie's benefits are free. You're going to pay, whatever his tax rate is, plus Social Security on the imputed value of her benefits, right? So be aware of that. Again, in Missoula, most of us don't have a compensation package full of non-cash items. That's very common in major metropolitan areas. Interest income. Okay, so where is that under 1040? What line? Yeah, I think line 7 is wages, taxes, and comp, or wages and comp. Line 8 is interest. If you get a little bit of interest under $1,500, you just throw it straight on the 1040, right? If it's over $1,500, you have to go and complete a Schedule B. You will be doing Schedule Bs in this chapter. What else should I say about that? Okay, interest gets interesting. If it's bonds that are backed by governments, what do I mean by that? What's an example of a bond that's backed by a government?
Savings bonds, H bonds, EE bonds.
Yeah, anything issued by the federal government. Interest that is backed by full faith and credit of the United States government is not taxable, but only at the state level. And if there's interest on a bond that's backed by the full faith and credit of the state of Montana, or any municipality, then it's not taxed at the federal level. And if it's an in-state bond, it's not taxed either place. I'm going to put up a little matrix because this will cause you angst. Let me just talk about the different kinds of bonds and then I'll put up the little matrix. So there's double E's, double H's, and I's. Double E's you purchase at a discount. So I buy them at 92% of face value and then I redeem them at full face value. And the difference between the 92% and the redemption value is interest. Okay? And that's not taxed incrementally, that's taxed in the year that I redeem them. Series H bonds, those, we haven't had those for like 15 years, so I'm not going to worry about those. Series I, those are probably 8 or 9 years old, and those were introduced, their interest rate is tied to the rate of inflation. So they're adjusted twice a year. Okay, so let's see, maybe this is when I should do the little interest. I've got that up here. No, I don't. Okay, so let's take a look at this. So if oh, here's my pen. So if you've got, let's see, how should I do this? Okay. Taxable. Yes or no? No. Taxable, Fed or state? So federal bonds, like double E or I, are not taxable at the federal level. In other words, they don't show up on your 1040 at all. But they are taxed for Montana. So that means on the Montana tax return, you're not going to know the line item off the top of your head, but where's it going to show up on your Montana tax return if it's not in federal AGI? Sorry? Yeah, it's going to be in your what? I think your additions line. Remember, we start with federal AGI and then we adjust it to Montana AGI. So federal bonds are not showing up in your federal AGI, the interest, but they're going to be added back on Montana. Conversely, you can have two kinds of state bonds. You can have, if you're a Montana resident, you could invest in a Tennessee bond or you could invest in a Montana bond, right? So a non-Montana, and they're called muni bonds. Muni bond is short for municipal bond, and it's how we fund things like this college or a wastewater treatment plant or roads. Specific bond, it's how we bought our open space around Montana. Those are municipal bonds, or around Missoula, excuse me. Okay, so if I buy a muni bond, well, any muni bonds, Montana or non-Montana, are taxable at the federal level. You guys, I think I've got this mixed up. These guys aren't taxed anywhere, Montana muni bonds. Non-Montana muni bonds, I'm going to have to think about this for a second. Sorry. This is the only thing that I feel confident of right now, is these aren't taxed anywhere. I think I might have this mixed up. So hold that thought.
Where would we go to find that information?
I can find it in about 2 seconds on the Montana Department of Revenue site or the Montana or the federal site. Let's see. Yeah, maybe we should figure that out right now. Or actually, if you've got your manual recap handy on both, on the Montana page, it's on the additions and subtractions, it'll tell you. 17. Okay, long form. Sorry about this. This is always a, actually should probably write down that. Okay. Where's our, okay, here's additions to interest. Okay, so it's not, yeah, that's right, okay. Yep, okay, so here's what I was looking for. So, it tells us here, in Montana, the interest in mutual fund income that you receive from bonds and obligations of another state has got to be added back. So it's not taxed if it's Montana muni bond, but it's added back if it's a non-Montana muni bond.
So it's added to your federal AGI for the Montana form?
Yeah, so that's it right here. So in Montana, it's, if for a non-Montana muni bond, it's added back. There we go, that's it. Is this clear as day? So it was exactly opposite of what I said. I thought that looked good. So let's do this again. Federal interest is taxable on the federal tax return, but it is subtracted, it's going to be a subtraction for Montana. So we can see that down here on the deductions. Yeah, line 1. Okay, so this is a line 1 reduction on Montana. And then it's added back here, so it's an addition. Okay. So, recap, sorry, this is a nightmare, but it's, so copy this down without all the schedules. So for a federal interest on a federal tax return is includable, but it's not taxable at the state level, so you have to, it's a reduction, right? So it goes on that schedule 2 where it shows all your reductions and additions. If you've got an out-of-state municipal bond, like a California bond, it's not taxable at the federal level, but Montana taxes it. So you've got to add it back. If you buy a Montana bond, it's not taxable anywhere. It doesn't show on your tax return at all. It's not taxable for the feds, and you don't have to add it back on Montana. So if I buy a Montana bond, it's not taxable.
So no muni bonds are taxable?
At the fed level. And that's, I should have, if I thought about this for a hot second, that's their way of subsidizing municipal projects, not taxable at the federal level. That's why muni bonds are highly desirable by people that are in a high tax bracket. You pay no federal tax on it. Okay?
So if it's in the IRA, then it doesn't apply to any.
IRAs, nothing's taxable at all till you pull them out. Non-issue. Same with the 401k. People give me that every year when I do their taxes. All their 401k statements, I don't need to see them unless they've had a distribution. And if they've had a distribution, I'm going to get a 1099-R, right, that shows that they've taken money out of their IRA or their 401k. Okay, sorry about that. So, and these additions and reductions, do you know where I'm talking about that on the Montana tax return? Like roughly down in line 63 and 64 or something like that, after Montana AGI. And on your Montana recap, right, we have our manual recap, the long one for the feds, and then on the second page there's that short one for Montana. You'll see on the addition side, there's a space for non-Montana munis. And on the reduction side, there's a space or federal interest. When you enter it in here, it's going to be a real pain in the butt. And we'll do a couple of those together because cases 4 and 5, they have interest, muni interest and federal bond interest. So we'll do that entry together, or one of them at least, so that you get the hang of it. Okay, dividends. Dividends come on a 1099 DIV. There's 3 kinds: ordinary, non-taxable, and capital. These guys are taxed at a reduced rate because they're capital in nature. Ordinary dividends are most common. You take them to a Schedule B. If they're qualified dividends, which you'll see on the 1099 div, it's got little fields for each kind of dividend. So it'll tell you if they're qualified, they're also taxed at that reduced rate. And do you remember what those rates were? And 20. Yep, exactly. So capital transactions and qualified dividends, they're taxed at those preferred rates of 0, 10, 15, and 20. Right? Did you remember that matrix in chapter 1? That's applying to this as well. Any questions about what I'm talking about, the preferred rates? It's really important because now when you start calculating on your manual recaps, the tax, you can't just take taxable income straight to the table. How come? Yeah, you've got different tax rates. Exactly. So for example, if I'm telling you now that somebody's got TI, maybe you could look this up if you've got your book handy. Let's see if we can figure this out. I've got TI, I'm married filing joint. I've got TI of 126,300, but I look on the Schedule B, and on the Schedule B, there's qualified dividends equal to 29,000. And we don't need to actually figure the tax, but I want you to tell me what you think you would do. So I've got TI of 126,300, I'm married filing joint. On my Schedule B, I can see obviously I've got a chunk of money somewhere because I got dividends of 29 grand. What am I going to do? What's the math?
Subtract 29 grand from the 126.
First off, I can't just take the 126.3 to the tables, right? Because I know I've got preferred rates. Now, you do need to go to the tables and tell me what their highest marginal tax rate is, correct? So see if you can figure that out for me. So we've got 2 levels of taxation. What's that going to be? 97.3 is at regular rates. Okay, so where are you going to find the 97.3, the tax on the 97.3? Yep, you got to go to the tables. And I think you're actually going to have to, even though it's on the tables that give you tax per bracket, you're going to need to go to the little synopsis and tell me what their highest marginal tax rate is, because that's how you determine what the qualified dividends are taxed at. We have to find the highest marginal rate to go to the matrix to figure out whether it's at 0, 10, 15, or 20. Okay. So highest marginal tax bracket here is 25%. You can pull this number straight off the tables, right? Now, what do? I've got to go to, I don't know these numbers off the top of my head. I've got to go to that matrix that I put up somewhere. Oops, was that it? Here, there. Yeah, my highest ordinary tax bracket is 25%, then what is my capital gains and my qualified dividends rate? 15%. So I would probably print up this slide number 32, from chapter 1 so that I had it handy. I don't process this stuff, or I don't even try and remember this stuff because it's just all lookable, upable easily. You just have to know it's at a different tax rate. I need to go look that up. So qualified dividends and anything capital, any capital gain transactions, including capital gain dividends, CGDs. And again, where are you going to see that? You're going to see that, you're going to see it on the Schedule B, but you're going to CC it on your 1099 div. And it's got all the different boxes. You know, one's going to be your capital gain dividends, and one's going to be your ordinary dividends, and one's going to be your qualified dividends. And it's going to just put those numbers in each of the little boxes, and you've got to pick them out and get them into the right fields in the software. And you also, okay, this is worth looking at on your 1040. Tell me, for example, if I gave you a 1099 div, and there was $1,000 of capital gain and $2,000 of ordinary dividends, where would those two numbers show up on the face of your 1040? One more time. Okay, what does line 9 say? Okay, so is all of that going to show up there? Right, so, but there's no qualified up on this 1099 div. All I have is capital and ordinary. That's what I'm trying to get you to think about. So the ordinary goes on line, what did you say, Carlos? 9? Huh? 9A.
Yeah.
Well, where does the grand go? It's going to go exactly, that is going to travel to your Schedule B and merge with all your other capital transactions. Like I sold some jewelry and I lost a bunch of money on gold. And then I had $1,000 of capital dividends. That all melds together in your Schedule B and then migrates to the face of the 1040 as one number. It's a gain, it's taxable at reduced rates. It's a loss, you're limited to $3,000. You with me? You're supposed to smile and nod. I said smile and nod.
Smiling on you.
Okay. Okay. So you'll get this as we transfer it to the tax returns too. See, where am I here? Chapter 2. Oh my God! After all that, here it is, right here. Alimony. If you pay alimony, then you get a deduction. And that deduction is one of our, do you remember where that is? Shows up on the 1040? Okay, if it's coming into you, it shows up on what line? Yeah, I don't actually have my tax return in front of me, but that sounds about right. Yeah, alimony received is taxable to the payee and deductible to the payor. 31A, you deduct it. I got to put the social security number of who I pay it to, and that's going to be cross-checked that he or she is claiming it, right? Child support, not deductible, not taxable. Alimony, deductible and taxable. It's got to meet these 5 caveats, which basically just says it's really alimony. In other words, it can't be made in connection, or it can't continue after death. It can't be contingent on the age of a child. Those things are really child support, okay? So you can't live together and transfer income via alimony.
What about maintenance?
What about maintenance? I don't know what that means. What is
We have
maintenance?
maintenance so they can keep the lifestyle that you like work for alimony.
Oh. Well, if it's a written instrument that says, I got to pay you this because we're divorced, then it's alimony. And it's cash, not property.
Property that you lose in the settlement, is that deductible as a loss?
So if you're getting paid child
It's not taxable.
So would you-
That's why when you go to court,
Yeah.
you want, say that your ex has got to pay you whatever, $5,000 a month. I'm going to fight, if it's me getting the money from him, I'm going to fight that it's all child support, and he's going to fight that it's all alimony
Right.
from a tax standpoint.
Yeah,
And then you're going to come down the middle and say,
so would you need to keep like a schedule of the payments?
oh, sure.
And so you don't get taxed on it?
Yeah,
Like the direct
absolutely.
Deposit. Okay.
Yeah, you're,
Practical information.
yeah, no, you're absolutely going to want that. And that's why when you guys, if any of you go into tax practices,
Yeah.
or just go into life and have an accountant, or you are accountant, sorry, or training to be aware before you consummate transactions that you want to think about the tax implications. I've talked to you guys about that before. People will call me and be like, oh, I closed on this real estate or this business deal, or the divorce is finalized. I'm like, oh my God, call your accountant before you finalize it, right? There's nothing you can do once the transaction's consummated. Other issues, I'm not going to go too far into this. Okay, so complying with the 2016 written divorce decree, Frederick pays Shauna $1,800 a month. The decree specifies the payments will be reduced 40% when their daughter becomes 18. So it says in the divorce decree that he pays her $1,800 a month in alimony, but it also says in the decree that that number is altered by a 40% discount when the kiddo turns 18. How much can Frederick deduct? He can only deduct, they're calling it alimony in the divorce decree, the attorney's trying to be clever. It's not, because it's contingent on the age of the child. So only 60% of that number is deductible.
Only 60% is really alimony.
Yes. Again, so that's sort of, what the words of the contract say and what the spirit of the contract really is are two different things, because 40% of it goes away when the kid's 18. Child support, not deductible to the payer, not taxable to the payee. If I'm paying both, right, so my decree says I've got to pay my ex-husband child support and alimony, and I get behind on the child support, everything I pay him is child support until I get current. So nothing's deductible until I get current with the back child support. Okay, prizes and awards. Yay, Lisa, thank you for your 26 years of service at the University of Montana. We get snappy little pins. But say that you work for a company and you got a car. What happens to that car as far as taxability to you? Everything over $400 is taxable if you don't have a plan in place. Let me not say that, don't like it. You don't pay tax on prizes and awards up to $400. Or up to $1,600 if your company has got an approved plan. And it's for length of service or a safety record. So I'm an elevator repairwoman and I get $1,000, I don't know, gift certificate to Best Buy for Christmas. Yay! Okay. They've got an approved plan in place. That's not going to show up on my W-2. I get a $10,000 trip to the Caribbean. They have a plan in place to celebrate my 30 years there. $10,000 minus $1,600 is taxable. I get the $10,000 trip, but it's just because I was the top saleswoman. Entire $10,000.
It gets to show up in the W-2, so you can collect on it as well.
Oh yeah, absolutely, everything. Gifts, prizes. Lots of times, like this is a true story, my mother-in-law is really active in philanthropy on the East Coast, and she talked one of her friends into donating a $25,000 RV to be raffled off. They're building a shelter for disadvantaged children. So the guy gives her the $25,000 RV from his RV business, and they raffle it, and they make a shit ton of money, and somebody wins it, and the people that win it, what do they have to do? Yeah, because sell it because they gotta pay taxes on it, they don't have the cash to pay taxes on it. Right? Shows up, you get you're gonna get 1099 if you're not an employee, W-2 if you are an employee. Right? So you gotta be very careful about that.
What's the proof?
Anytime when you hear the words approved plan in correlation to the Internal Revenue Service, it means that somewhere in the Internal Revenue Code, the IRC, there's a template of what you have to comply with to make the IRS smile down on it. So it's got to say right in there it's for length of service or safety. And it's got to be distributed within 45 days of being declared. And, it just talks about title transfer and all the basics and stuff like that. So it's approved by the IRS.
So I get longevity. which
Yeah.
is based on length of service.
Yep,
That is part of my paycheck.
yep,
So can I deduct that?
no.
Darn. But the thing is based on length of service, so, and it, what, any raise or anything is.
It's
not
all
based on-
taxable. It's just going to show up on your
It
W-2.
does.
Yeah,
Okay.
fully taxable. Okay, annuities and pensions. Bear with me here. This is a little bit of a convoluted area. So can anybody tell me what they think an annuity is?
You're buying a pension.
You're buying a pension. So
You're right.
yeah, that's a fairly good assessment. Now, and it's a huge decision all of us have to make when we retire. So I worked my whole life and I saved $300,000. Now I'm 65, or probably more accurately in this day and age, 70 or 70. And this 300 grand's gotta last me forever. Do I want to just do the calculations and take out, $2,800 and $2,836 a month, right? Or do I want to give my money to Klaus and have him do a calculation and pay me a set amount for the rest of my life? What do I have to think about?
How long you're gonna live?
Yeah, I need a crystal ball, don't I? How long am I going to live? So if I hand you my life's earnings and I'm 65, and I'm not a smoker, and I don't have any compelling health issues, and I come from, my mom died at 93, I've got an aunt that's alive at 101, blah, 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 blah.
You know what, yoga?
Yeah, good, healthy yoga, great. I think I'm going to live till I'm 95. Take my 300 grand, because I do the math, and I'm going to give him 300 grand, and I'm going to get back $500,000. Right? But I get in my car after I write in the check, and I run into a bus. Do my heirs get anything? Nada. Klaus was very sad, but not so much really. Because he's got my 300 grand.
I'm not gonna live.
Okay, so that's how annuities work. It is the greatest crap shot you will ever make. Right?
What kind of return do you get on
It depends on how much you buy into. I mean, are you going to buy into something high risk when you're 65?
it? Well, why don't you just take that money and just invest it yourself?
Some people do that. And you say, you know what, I think I'm going to live to about 85. When you do your math, and when you're 85, guess what? You wake up and you're freaking broke. You take the risk on yourself of making sure your money lasts you. Now, we're all accountants. We know how to do the math to figure out the numbers, right? It's a present value problem, isn't it? This money's got to last us into the future, and we need to tie it back into a number we have today. And it's not as easy, as we all know, than taking the 300,000 and dividing by however many months I think I've left in my life because of interest and inflation. But we can do those calculations. Now, if you underguess, you leave an estate. No, other way around. If you underguess, you run out of money. Ah, shut up. If you overguess, you leave an estate for your heirs.
But they're not very up to the time.
So present value is $1 10 years from now isn't the same as $1 today because of the value of interest, compounding of interest. So as we go into the future, we compound interest. As we go into the future and come back, we discount.
Look at the time value.
The same thing. It is time value of money. Present value and future value is synonymous with time value of money. So, what does this have to do with taxes? What this has to do with taxes And actually, my assessment, or where I think I'm at when I think about this, my sister just made this decision. She's single. She just, so she's only got herself to depend on. She just made this decision 4 years ago. And we did a lot of work together to help her make that decision. Where I think I'm at is halfsies. I think I take my amount and I take half of the risk on myself and I give half of it to the annuity guy.
So your recognition and annuities are considered taxable interest, taxable dividends, income?
The part that comes back to, and that's the tricky thing right here, the second bullet, the part that's taxable of the money that I get every month from my annuity guy or gal, some of it is a return of my own money, okay? That's not taxable. Some of it's earnings, that's taxable. So you gotta figure that out. And luckily, the IRS provides us mortality tables that tells us just how long we're gonna live. Statistically, fantastic. Women, health, so mortality tables are always split into smoking and non-smoking. There's conversation about BMI being included in there too, as a health factor, body mass index. So how under, over, adequately weighted are you, I guess? Measured by the things, they put on your arms and they take your BMI. It's an indication of everything from diabetes to lots of health issues. Anyways, they'll tell you if you're a normal BMI, non-smoking female, you're going to live to 87 in America. Okay? If you're Cambodian, the number's 52.
Does it factor in race?
No. Nope. Gender, smoking, or non-smoking in BMI. There's a million more things. It's a pretty, fairly decent way, I would imagine, to categorically do this. Now, so what happens? The basic rule is that you want to calculate your exclusion ratio. In other words, how much of the money that they're giving back to me every month is excluded. And the exclusion ratio, here's the calc. Investment in contract, here's my $300,000. That's my investment in the contract. Divided by how much do I get every year times my life expectancy. And the life expectancy, again, coming from the mortality tables. So really that's saying what percentage, I give you 300 grand, and you're gonna pay me 10 grand a year and I'm supposed to live another 20 years, or 30 years, 40 years, let's say.
1.5.
That's your exclusion contract, your exclusion ratio. And it's under 100%, my number's much better. Under 100%. I'm gonna be getting a whole bunch more than 10 grand a year. If I give you 200, I'm gonna be getting 30 grand a year. Then once I figure out how much of my payments are excluded, I just multiply that by the amount of the annuity that I get every year, and that piece is not taxable. Now, in reality, what do annuities get reported on? What do they come on? A document, 1099-R. Okay. Pardon? No, that comes on a 1099-S. M-I-S-C. 1099-Rs, you guys, are, I think it stands for retirement. It's your 401k distributions, it's your annuities, it's your pension distributions.
For calculation purposes, annuity and pension, is that fine?
No. Annuity is you've given them money, you bought a contract. A pension is like I work for John Deere my whole life and now they're sending me a check. I don't have any investment in the contract, or I might have an investment in the contract if I paid in.
So when it says annuities / pensions here,
Yeah, those really aren't synonymous. They can be. Okay, so
You turn your pension into an annuity.
you can. So I worked for John Deere my whole life and I've got, $263,000 sitting in there. I can say to them, again, do I want to take the risk of that $263,000 tree's gonna last me forever? Maybe. Okay? If I'm not well, or I don't have longevity in my family, or I've got a kid that I know, I've got to leave money to, or they're gonna just implode, I'm not gonna buy an annuity because I want an estate, right? So what do I mean by that? If you buy an annuity contract or convert your pension to an annuity, and you die the next day, it's all gone. Make sure you understand that. You might not give a shit if you don't have kids.
I was gonna say.
You might not care.
We don't care what my wife.
Well, some people still care because they want to leave it to charity. Or another family member, or, charity, you should phone them. But, or you might have kids and say,
True.
I put them through college here on their own. Personal process. They have a good education, they were raised in a loving and nurturing household. Have at it, I'm gonna spend out every penny you make. But, everyone's got their own set of values around that. Okay. So, let's try this. So get up your paper and pencil, please. So Dan has saved $750,000 in his retirement account. And he decides to purchase an annuity. And he's gonna get $4,800 a month. And on the IRS tables, based on BMI is not officially incorporated. So, and the tables, I think they replicate your work are just man and woman, they're gender-based, I don't think they really know the details. Anyway, I pulled the number off the table, so he's gonna live another 19 years. How much, first off, is his annual annuity? And second off, how much of it is, did I ask for taxable? No. How much is excludable and how much is taxable? Hands over 750 grand.
It's 57.6 a year.
So he's calculated $4,800 a month, right? Times 12 months. So you're gonna have to go back to the prior slide and do that math, please. And I'll just give you a couple minutes to do that. So what percentage of Din's annuity is tax free. What? 68.5%. Yep. So, therefore, if you're his accountant, how much is he going to be paying tax on a year? Can somebody give me that math real quick? What times what? How much is he? This is the exclusion ratio. Right, so he's paying taxes on the difference, isn't he? 18,144. Okay. So everybody with the math so far? Next question. You're his accountant, he's 68 years old, he's single, so you gotta file a tax return? And if so, what's his tax bill gonna be?
That's all his income.
Yep. He's 68 years old and single. No dependents. Does he have to file a tax return? And if so, what's his tax bill going to be? I'm sorry, go ahead, Elizabeth. What's that number?
I guess it's taxable.
Right. That's what we've got to find is TI. This is his gross income, isn't it?
So that's standard.
Sure.
Deduction, exemption,
Sure,
And a bonus for being overseas.
sure.
So I got 6,244 for taxable.
Okay, what did you have for his standard deduction?
Well, 6,300 plus 4050 plus 15.
So 63 plus 1550, 7850 for his deduction,
Oh, yeah.
right? Is that correct? Is the 1550 what you add on if you're single?
Yeah.
I don't have my book. Okay, and then the exemption,
Yeah. 4050.
and that gives me what?
Uh,
11,9, 6244?
6244.
And I can eyeball that and see that he's in the 10% bracket. I don't even have to do math on that. This is the kind of thing when somebody comes in your office, if you're like, oh, I don't know, I mean, if you can calculate this in 5 minutes and go, you're gonna have $624. Yeah, napkin math, it makes you look pretty competent. If I could do his tax return tomorrow and I know exactly what the result's gonna be, I gotta tack on a couple percentage points for his state income tax bill. All right? Then he's gonna say, I don't wanna pay that, what am I gonna say to him? Well, I'm gonna try and see if I can get his itemized deductions over to 7850. If he's got that kind of money saved, he probably owns real estate. One of the problems with retiring is people have a tendency to have their houses paid off. So they start losing their itemized deductions because they've lost a mortgage interest deduction. And that's what gets most people over the standard.
They still got the property tax rate.
Yeah, but that does, like in Montana, that doesn't get you over the standard. In Texas, it does, because you don't have income tax. So I mean, like, my sister pays $8,000 on a little cottage, you know, in taxes. But in Montana, we don't have very high property tax bills, relatively speaking. Okay, do you see where these things are starting to all fit together? One more thing and then we'll have a stretch. Okay, and also in this, make sure that you're paying attention. This particular one asks you what's excludable from tax. That's an important number, but really at the end of the day, you want to know what's includable, right? So all the math we did here was what's excludable. To get includable, then you have to subtract that from the gross. Okay, so this was where my kind of vague answer was on our annuities and pensions, the same thing. So a true pension, like historically, is like, International Harvester, John Deere, IBM or Johnson & Johnson, the old kind of dogs of the Dow kind of thing, where they put money into an account your whole life and then they pay you when you retire. Okay? That was like the old school pension. Then kind of like in the 70s, late 60s, 70s, that sort of morphed into, well, we'll still do that, but you've got to chip in a few bucks out of your pocket too, towards your pension. Okay, so that was like the merge. Now I would make a case, in a lot of markets, it's morphed even further to the employer may or may not contribute anything. And it's pretty much what you put in, right? So what's important to keep in the back of your head is you never pay tax on money that comes back up to you that you put into it. But the earnings, absolutely. So like Klaus was talking earlier about, getting interest in, what was your example of IRA? Yeah. So IRA, Roth IRA, 401k, TIO, simple stuff, it doesn't matter what your instrument is that you're saving money in, you don't pay tax on any earnings while you're earning it because it's in a tax-deferred account. You with me? That's the power. There's not a tax bite coming out every year, so you compound. But when you pull that money out, taxable.
That's why you want new bonds in the 100.
Right, because there's no reason to. You don't have a tax bite anyways. Great point. Yeah, you would have your muni bond purchases and your liquid investment accounts that weren't already tax deferred. Great point.
So where it's the contributions of pre or post tax.
It totally matters if they're pre or post tax. So what this is saying is my employer, say the University of Montana, puts in, I think, 7.08% of my gross. Yeah, it's not great, but it's better than kicking the pants. So that doesn't show up on my W-2, right? But when I pull that money out in some form, whether it's an annuity and I buy a contract or whatever you decide to do, that's going to be taxable when it comes out, right? Then I put in 7.08%. What happens to that when my money comes out? Not taxable, but what about the amount that I made on my 7.08%? Taxable. So I'm taxed on everything that you put in, all the earnings on the part that you put in, and all the earnings on the part I put in, but not the part I put in. Does that make sense? So, and then the other thing that's helpful is oftentimes, and most often, if you've got a instrument that you're investing in that's got some integrity, they will tell you on the 1099-R which part is taxable and not taxable. Okay, let's get up and have a stretch, and then we'll reconvene. Take a couple minutes and go to the bathroom or stretch or do whatever you need to do, and then we'll reconvene. Moodle. Hi. Sure. Wow.
So I think that
Are you?
three things. Let's discuss.
Oh, and that brought up this?
It gets me to here. The second page. Number one is, easy to six.
Okay, you know, maybe it would be right now, but that's okay. If it's honest. I would also, by the way, really emphasize your tech background in your interview.
Because I don't know that much about it. I'm good at playing around with stuff and stuff. I
That's
don't know what I'm doing.
That's hugely important. The guy that's like super technically competent in accounting, but like, my printer doesn't work, I can't get my screen on, which is what I'm like, believe me, I tech runs when they see me coming. That's a good, you know, it's a good thing to get this thing.
So the reason that it wasn't training is after I started with printers. I think I started with printers properly. They don't have any price things in their paper. So it's set to print printers. I'm not sure if that's, if it's not supposed to be. But, so she brought me up and grabbed the IT person now since I've got this. Meaning that by the end of the day, if I can try to do it. We'll find out for sure whether it's supposed to or not. But may not get it. But, come back at it. Even I got out. You know, so I guarantee you have to.
Okay. Life insurance. If you invest in life insurance, or if your spouse invests in life insurance and he or she passes and you're the beneficiary, you're going to get a chunk of money, right? It's called face value. And that's not taxable. Only in very rare situations are the proceeds, and proceeds are an interchangeable term of face value or payout. Only in rare situations are the proceeds taxable. The proceeds are taxable if, this is next slide. Oh, I don't have it on here. So the only time that proceeds are taxable is if they're in, like I lent you $100,000 and part of it was you made me beneficiary on your policy, and then I get the $100,000. Then it's part of a business transaction. It's a pretty rare situation. So for most of our purposes, let's just say life insurance proceeds are non-taxable. Sometimes you can set up your face value to pay you over a number of years, right? Which might be to pay the beneficiary over a number of years, which is if you have pretty solid financial planning. If you're leaving a chunk of money, for example, to a spouse who may or may not have really great money handling skills, you may want him or her to have it over a period of time, in which case then they'll be getting some interest along with it, right? Because the money's sitting somewhere being paid out. The interest is taxable, always, right? The interest or earnings are taxable. Okay, so, okay, viatical settlements. These are, this is a situation where I have a life policy, and it's of no benefit for me to wait to die for the money to go to somebody else because I can't pay my medical bills right now. I'm terminally ill or I'm chronically sick.
They sell it at a discount.
I sell my life insurance policy at a discount. Okay. These viatical settlements started, can anybody guess, in the 80s?
Yeah, they're used up.
It was during the AIDS epidemic. It's super morbid and it was super profitable. But what happened was, I think it originated like in Jersey or New York or something. And so these brokers brokered life policies for AIDS victims, patients. So I come out and I buy all of your life policies at 60% of their face value, and then I package them and I sell them to retirees in Florida. Okay? And then guess what happened?
People start losing money.
The AZT cocktail was discovered. People weren't dying. People in Florida were like, dude, you said they were going to all die. They didn't die. When like to cash in. It's horrible. Okay? But it's still a pretty thriving instrument. And useful and beneficial if you're somebody that's got a $200,000 policy and a ton of medical bills, or it's just like, I'm terminally ill, I'm going to die in 6 months. I want to go do what I want to do for the last 6 months of my life. So I think it's got a place. It's just the origins. So again, these are excludable if you've got the MD. I think it's even 2 MDs that are attesting to that you're terminally ill or chronically ill. You're not going to die in the immediate future necessarily, but you're quadriplegic, or you've got ALS, or you've got something that you're not, able to. This is the life insurance transferred for value. If you owe somebody money, part of it may be taxable. Okay, gifts and inheritances. Specific exclusion. When you die and you pass your assets on, that actual action, that transaction is not taxable. Now, that's not to say that you might not have to pay, that your estate might not have to pay estate tax. But the heirs don't have to pay tax. So what am I talking about? When I die, say that I die and I've got $800,000 of assets at the house and the 401k, blah, blah, blah. Right? So here's this package. I'm single. I've got 4 kids. That $800,000 doesn't just get dispersed directly to them, does it? First it goes into something called an estate. Right? And if the will is complicated or it's going to take some time, that it, to sell the house and disperse the assets, that money and those assets will sit in your estate, and they're probably going to generate some income. Okay? So the estate may have to pay tax on that. Then it gets dispersed to the heirs. Do the heirs have to pay tax on, if there's 4 of them, say $200,000 each? No, that transfer of assets is tax-free. Now, that all changes for estates that are over the estate, taxable estate limits. And I've only done maybe 5 estate tax returns in my whole life. I am not conversant with them. I just generally have people of that net worth. I think that the annual estate amount now is about 1.5. Yeah. Like I said, I really don't keep up with it. It's a lot. It's a lot. In other words, you don't pay estate tax until your estate's over this limit. It's let me think about it in a second, but 1 or 2 million. Okay. Gifts. I can gift. Yeah, that's a non-taxable transaction, unless I gift over $14,000 per person per year. So, what a lot of people will do that's hitting like the estate limits is start gifting to their kids and grandkids and nieces and nephews. You can gift to everybody up to $14,000 a year and pass that tax-free. In business, you can give gifts, but it's really a small amount. I think it's like up to $25 per person per year that you can write off in a business on a Schedule C. Okay, so if I think, oh, I want to do business with Carlos, so my business gave him a gift worth $2,500, and I want to write that off on my tax return as a business expense. They're going to say, hey, that's either compensation or it's corruption or bribery, and that's non-deductible. Okay. Although in lots of parts, that's how you do business, isn't it? I mean, it's absolutely, positively, 110% accepted as common business practice. And if you don't engage in it, You're not gonna get your license stamped or your, you're not gonna get
The contract.
the contract, you're not gonna get, I mean, nothing's gonna move forward, period, end of story. We met this guy from like, I don't know, Virginia or something, in Costa Rica, and he was trying to open, and this was years ago, probably 15, 16 years ago, he was trying to open like a juice shop or a sandwich shop or something, and something super, super simple in La Fortuna, which is right in the center of Costa Rica. And the capital of Costa Rica is set up in the coffee country in Cordillera Central in San Jose. It's like 4 hours away. It's a really dangerous road from La Fortuna to San Jose. And this guy, he was American, He didn't understand that when you go stand in line for 6 hours, and the guy's like, so you really want, your health certificate stamped? How many colones do you have? That's their money. He just didn't process it. We don't think like that. He said, well, but it said on the sign that it was only 20 colones. What do you mean you want 200? So he wouldn't get the damn thing stamped, and he'd have to drive all the way back, and then he comes back. It's like, and you just have to pay the bribe. And everybody was like, it was in a government office. And it's like, dude, that's how it works. Next time he drives back over on these dangerous roads, it's like, right, so it says 20, but I'm going to pay 200. It's like, yeah, that's pretty much how it works. Now you can get your health certificate stamped. Okay, scholarships not taxable unless it's for room and board or any sort of compensation, like a scholarship, but also you've got to show up in my lab and do research, or scholarship, but also you've got to, TA or something. Then your scholarship is taxable. But scholarships that apply to tuition fees, books, equipment, non-taxable. My employer pays for my accident and health insurance, non-taxable. My employer pays for my meals and or lodging. Anybody remember this from payroll? Do you have to include that? It does depend. What does it depend on? Yeah, both of those things. You got to have a qualified plan in place. It's compliant with the Internal Revenue Code, and it's got to be for the employer's benefit. I want you guys to all stay at my peach farm because I need you out in the fields tomorrow morning harvesting. I don't want you to have to drive out from Atlanta to my remote rural Georgia farm, or whatever the version of that is. Lodging. So all these big campuses they have, like in Silicon Valley and Raleigh, Durham, where there's these very high-tech campuses, and there's all sorts of things like this that are a part of the plan. Right, your compensation plan, you get free meals, you get massages, your pets get massages, your dry cleaning gets done. That's all for the employee's benefit. That all shows up on your W-2. Okay, so that's not free at all. Muni bond interest. Okay, here's the calculation. Do you want to invest in a 6% muni bond or an 8% corporate bond? How do you decide? Logic says, oh, well, 8%, of course. But I got to pay tax on the 8%. What's the calculation? The calculation is you've got to compare them both after taxes. The 6% on the muni bond is after tax because there's no tax.
Federal tax.
Well, in Montana, a Montana muni bond, there's no tax anywhere, right? So 6% is my after-tax return. How am I going to compare that to my 8%? So tell me what you think, say I'm in the 28% federal bracket. Should I go with the 6 or the 8? You got to do this calculation right here. You got to compare after-tax return to after-tax return. So 6% is what my Lewistown wastewater treatment plant bond is paid.
Slightly ahead of
8% is the, I can't do that top of my head. 8% is the, Apple.
5.76.
huh?
5.76.
So 8% divided by 1 minus 0.28 equals 5.76.
I just did 0.2 or 0.72 times 8.
You have to do this calculation. Your after-tax return is the 6 divided by 1.1 minus 0.28. 0.72. So it's not a multiplication, it's a division problem. Okay, this one I did 33%. So, sorry, I thought that it was 28. So this guy, and this does get trickier because it's an out-of-city bond, but let's just say we're in Tennessee and, okay. So, I'm making this more complicated than it is. It's really a very simple calculation. We're trying to figure out what would he have to be making, what would he have to be making in a corporate bond that's fully taxed to be equal to the 6% bond, huh? Yeah, almost, okay. So he's going to have to be getting 8.96% on a corporate bond to be yielding the same amount as the 6% muni bond. That's actually not a calculation you would do as an accountant. That's a financial planner or financial product salesperson help. And obviously, the higher your tax bracket, the more beneficial muni bonds are. It's not definitely like, also, it's not something you'd ever put in a tax-free account. And if you're in the 10 or 15% bracket, there's probably not going to be enough of a differential to, really make it worth it. Unemployment, taxable for the feds, not taxable in Montana. So it's a subtraction in Montana. And also, I don't think I've ever said this, or maybe we talked about it in payroll, but tips aren't taxable in Montana either. That's another reduction. So on your manual recap for Montana, you can see, there's the actual reduction schedule is, there's 30 kinds of reductions, but like the 6 that you see most commonly, I put on the recap. Okay, so we've talked about FSAs and medical FSAs. Can anybody recap? Can anybody recap what an FSA is?
The flex spending account, money you put in, but you have to use it up by 30.
Yeah, I think you've got a month, maybe even a couple months.
But it's pre-tax, so it doesn't get any tax on it whatsoever.
Right, so an FSA, there's dependent care FSAs and there's medical FSAs. They used to be all merged into one.
But it requires you to know how much you're spending, so you don't lose it.
Right, so these are the most beneficial pre-tax benefit you can have. And what it says is, and it's particularly useful if you've got daycare or dependent care, because you know what your bills are. And it says you can put away $5,000. They take a chunk every month, right, from your paycheck, and they give it to a trustee. Most Montana employers or Missoula employers use Allegiance benefits. They send your money to Allegiance, and then you pay your daycare bill, and you give them a receipt, and you get your money out pre-tax. Now, it requires a whole nother level of financial planning because your paycheck's going to be down $400, right? And then you pay your daycare, you're like, oh my gosh, I've got nothing. You guys send your receipt, you get that out. But when you do the math on it, it can save thousands of dollars a year. With your medical stuff, you can go up to $2,550 a year, and that's for everything from your dentist to your contacts to your, medical insurance, co-pays, everything, prescriptions. And then we also, I think it's $220 a year. You can put money into mass transit pre-tax. So tuning my bicycle, buying my Metro Pass, I can do all that pre-tax too. And then use it, it's a 3-month grace period. So you can carry over it. So the thing about this, as John said, is that you've got to know how much you're going to be spending in the upcoming year, because if you overbid it, like say you fully fund the medical for $2,550, and then you only have $1,000 worth of expenses that year, you lose it. Huh? Right, yeah, you might, buying that over-the-counter stuff, which there's not very much over-the-counter stuff that you can even run through your flex. I feel like a lot of it's got to be like prescribed, like aspirin if you've got heart condition.
I was like 10 years, I was just under, and I needed to pump it to, I mean, I didn't want to lose even $10. So
Right.
I went and bought I asked them if you buy first aid supplies.
Oh, okay.
So about first aid kit.
Oh, okay.
Couldn't you just purchase medical supplies or equipment for the difference and then just return them for cash?
I don't know, I guess.
Or find a sympathetic doctor to just write an invoice for the work?
No, you're not gonna find that.
Most retail places, if it's purchased on a card, you can only return to the card now.
Oh,
So that's
our favorite, our guy that works in retail.
Okay, so then you can just buy it for resale then. And just resell
And
it.
now I'm on the street corner with a porta potty for a disabled guy.
Maybe if you're taking 20% loss versus 100% loss.
Yeah, I don't know.
With my.
I would just have a tendency to underbid my FS.
Yeah. We don't have cars, we have to turn in receipts for reimbursement.
Now some plans, which I love, our plan just converted to this a couple years ago, you get a card.
And that would be cool.
So like this year I put in, I don't know, it doesn't matter, so let's say $100 a month. So I put in $1,200 a month, and then I go to, co-pay my $30 to go see the doctor, and I give them my card. Okay. So that's really nice.
The two good things about it is if you have known costs, like your share of the medical insurance, you do it for that amount. And the other good thing is if you put in $200 a month, you're gonna end up with a $2,400 benefit, and if you incur 3 months into it, $2,400 in medical bills, they pay it right then, it doesn't wait till the end.
Love that. That is a huge
My
one.
understanding is you can't use an HSA to pay medical insurance premiums, but can you do it with the FSA?
Sure. And you can use that HSA to pay co-pay. Only if you're high deductible. You gotta be a high deductible.
To pay the premium, not the deductible.
Right.
And our medical benefits automatically take out the premiums free tax. So it's over
Right.
above this.
Yeah, absolutely. Now, I'm sorry, go ahead.
I don't know what they exactly call it, but you can sign up that if you want your premiums pre-tax or after tax.
And, okay, so that's really something to think about. Now, let me finish the thought here, and then I'll address that. The benefit of an HSA, the benefit of an FSA over an HSA is clearly what? Which tax? HSA is also income tax, free income tax. FICA, it's FICA. The benefit to an FSA is you don't have to pay FICA on it, 7.65%. The clear detrimental side to an FSA is use it or lose it. The benefit to an HSA, what happens to it if you don't use it? It rolls over. And say you're blessed enough that you don't, you put in $1,500 a year for 10 years and you barely use any of it. What do you get to do when you retire with it? You roll it to an IRA. So it's tax deferred, or there's a tax benefit to it over the long term, right? The the downsides to HSAs are it's not FICA free. You still have to pay FICA on it. And there's a much more serious litmus test on who gets to take them. You can only fund an HSA if you're in a high deductible plan And then it also phases out once your income gets at a certain level. So not everybody can even do an HSA. That's all.
What's the cap on the, Schedule A for your medical? How much do you have to have before you start?
Okay, so this is something too that a lot of people aren't aware of. That's a really good question.
To the, spending accounts because you didn't have enough medical to claim on taxes.
Here's how medical works for on your Schedule A. That's a really good point. Oh, also, so just to play on what Janice said, if you have an HSA or an FSA, and then you have medical bills that you use that pre-tax money to pay for, do you get to deduct that as a medical expense? No, you never get to double dip. If you pay for something with pre-tax dollars, you don't then get to turn around and deduct it, do you? Same with childcare. If you pay for your childcare with your FSA money, do you get to take the child dependent care credit? Heck no. So you've got that. That's yet another way you can add value to your clients. Oh, hey, really? You're taking? I see you're doing the 2441, which is a child dependent care credit. H&R Block threw that in and got you $230 from your child care credit. I can do a quick calculation and go, really, dude, you should have saved $1,400 on your FICA instead by funding a flex. So those are how you add value. H&R Block doesn't know how to do those calculations. They put the money in the software and it spits out a tax return. Here you go. Right? So that's another great example of something you can do super easily. Okay, so Janice's question was medical bills. So if my AGI between, say, married filing joint is 120,000, I'm trying to get to my itemized deductions and then my exemptions, right, to get to TI. Itemized deductions come on what schedule again? On the Schedule A. And can you tell me some of the things that go on the A again? What kinds of things do I get to deduct as for itemized deductions on my Schedule A? No, that's the face of the 1040.
Mortgage interest.
Okay, interest, yeah. What else? One more time. I think you get to deduct property taxes and state income tax. Taxes on your car, boat, things like that, right? Okay. I think you get to deduct your charity.
Medical expenses.
I think you get to deduct your medical, but only in excess of 10% of AGI, or 7.5% if you're 65 or older. So the first thing when somebody comes to me and says, should I bother doing, medical expenses for a lot of people can be a real pain in the ass to tally up. You got 2-3 kids and receipts everywhere for $5 here and $20 there. I'm going to eyeball your AGI and take 10% of that and tell you whether to bother or not. But then there's a caveat. And the caveat is, in Montana, how am I filing? Am I filing joint? Separate. So now I've got to look at the AGI and say, oh, you make 100 and she makes 20. So 10% of 20 is $2,000. And so in Montana, I can shove, remember how I told you that you can jack around where you put the deductions on Montana? I can push all the medical over to her. And if you've got $4,000, it's not going to help you on your feds, but it's going to buy you a $2,000 deduction on your state. So it's not first, I'll just do a cursory like, oh, I know I can't take it for feds, right? So, okay, let me just back up. So, okay, 100, I look at her stuff. Okay, 2 W-2s, maybe a 1099 dev. Okay, blah, blah, blah. In my head, I kind of quickly go around 120. Then I'm going to say, okay, there should be bother medical until we get to 12,000, right? We're on, because they're married filing separately. 100 on one side, 20 on the other on Montana. Then I can do a quick cursory sort of, whatever you call that napkin math, right? I'll say, oh, well, what do you think you got for medical bills? Oh, probably a good 4 or 5 grand. Yeah, well, then it's gonna be worth it. See what I'm saying? So again, those are value added things. You really want somebody to spend 3 hours accumulating all their medical bills, and then you're like, oh, sorry, it's not for 10%. That's gonna piss people off. So you want to tell them what it is you want them to spend time finding. So, as Janice said, we didn't get to that, and most people don't unless they've got really excessive medical bills. But make sure that on the state, that you can't push them all to one side, particularly if one's got a little bit higher income than the other. Where else is it going with that? Oh, so if you can't do that, you're gonna want to push it all through your pre-tax account. Right? Does that make sense? We're gonna have a case, I think, next chapter, where we've got a guy he's a single parent, he's got 2 kids, and he's got, a lot of these cases are like emulating real people, real clients that I have. And he funds an FSA, but he's got 2 or 3 kids, and he pays, a lot of medical bills. And braces on a kid, one kid's just in a snowboarding accident, I mean, he's got all this stuff going on. He uses his maximum FSA. So say his medical bills are 15, he uses his maximum FSA. What do you do when you go to calculate this? The 10% number. Yeah, you've got to take whatever the medical bills are minus the amount that he used of pre-tax dollars to pay for it, and that's the amount that you take times 10%. Okay? He's single, so I don't have to do any jacking around and married by them separately from mine. Okay, what other kinds of fringe benefits can we exclude? Group term life insurance. This is when your employer pays, because you guys all work for me and I bought life insurance for all of you. Here at the university, we each have $30,000 life insurance. Basically meant for your final costs. Okay? So, but if, like, I provide $50,000 for everybody, but for Heather, I buy $1 million policy, then part of those premiums for her key man or key woman life, is what it's called, key woman life policy, is going to be taxable. I can exclude the value of tuition that I provide you up to $5,250 a year, as long as it's a non-discriminatory policy. I can deduct discounts. You work for JetBlue, and you guys all get X amount of free plane tickets a year, excludable. Okay. Working condition fringe, I provide you with a cell phone, a laptop, whatever, that's a fringe benefit. Certainly that's good for you, not taxable because it's part of working. Condition de minimis fringe benefit, stuff that's so small it's not worth tracking. Okay. I give you all a massage once a year at the local masseuse for $80. Yeah, I'm not trying to put that on anybody. Tuition reduction, value of membership to athletic facilities. There's certain caveats to that. So if I buy you, again, Missoula is not a great example. I think our most expensive country club's like $3 grand a year. But I mean, if you live in Cali or Arizona, some of the country clubs, the membership fees are 40, 50 grand a year. That part of that is going to be taxable based upon your percentage of use for business purposes. Retirement planning, other excludable fringe benefits. So there are a few things you can do for your people that aren't going to show up on the W-2, but it's really limited. And it's all back to those tables, table 2-1, 2-2, and 2-3. Okay, Social Security. This is a very big hot button. I get so sick of talking to people about this because they really don't know what they're talking about. My Social Security is all taxable. Yeah, probably not. The way it works is either 0% of it's taxable, half of it's taxable, or 85% of it's taxable. Right? So in no situation is all your Social Security ever taxable. How do you do the calculation to determine whether 0% is taxable, 50% is taxable, or 85% is taxable? There is, on pages 25 and 26, there's some worksheets. But it's basically, it depends upon whether you're single or not, or household, or married by an jointly, blah, blah, blah. But when you start getting Social Security benefits, if you're pretty low income, nothing's gonna be taxable. If you're, and again, this is based on filing status, but if you're what you would call, probably widely, at least in Montana, identify as middle income, I'm making between around $10,000 and $50,000 a year in my retirement with other income besides Social Security. Right? So I get a pension, or I still got a part-time job, or whatever. Probably 50% of my Social Security benefits are going to be taxable. And if I'm pretty high income, like I'm getting $6,000 a month from my annuity, and my employer is also paying me another $3,000 a month in pension, then up to 85% of your Social Security benefits will be taxable. So that's how that works. There's different rules for Montana. There's a different worksheet. I can't say that too many people in my experience have big adjustments on Montana. Honestly, and I rarely ever say this, but it's one of those things I just plug in the software and let it do. The Montana worksheet's like 4 pages long. It's like, a few times I've worked it through, it's like $28 add back. And I'm like, oh, God's sake, that's not, I can't bill out for that time to do that calc. So I just plug it in the computer and let it do it. It's usually insignificant. The end. For Thursday, you're going to turn in your tax returns. Okay? Into your tax returns. You are going to do your homework for Chapter 2. So when you turn in your tax returns on Thursday, your recaps are in the front, and then your federal tax return, and then your Montana tax return. If you owe money, you will get something called a coupon out. For the feds, it's a 1040V, and for Montana, it's called an IT. Those coupons you cut out, and you staple on the front where the check would go. So what I'm saying is, if you owe money, what did I do with that pen? If you owe money, you're going to get a coupon. And on the 1040, you staple it right out. So here it says 1040. Here's where your 1040V goes, stapled. And if you still fill a hard copy out, you're going to have your W-2s are going to be here, and your check's going to be here too. On Montana, the coupon's called an IT, and it's stapled right here. So what I'm wanting you to do is to turn in the tax returns to me like you were getting ready to sign them manually. Don't forget to sign your tax return as a preparer. If you get paid to file a tax return, to prepare a tax return, you've got to sign it. So make sure you sign both the federal and the state. That's it. Tax returns, homework for Chapter 2. Hasta luego.